So good morning, everyone, and welcome today to this TRV Risk Monitor number 1 2026 webinar. I would like to kindly remind you that the webinar is recorded. You are all muted by default with your cameras off, but you will be able, after the presentation, to raise any questions you may have in the Q&A box. So I will give the floor to Stefan Kern, head of the Economics, Financial Stability and Risk Department in ESMA. So Stefan, the floor is yours.
Thank you so much, Cicely, for introducing the webinar today. Welcome also from my side to our latest TRV webinar that we are offering to you as part of the publication of the latest edition of the Trends, Risks and Vulnerabilities report. As you know, this is our semi-annual risk monitoring report that we published on the 11th of March. It's available on our ESMA webpage, and it contains a lot of risk and analytical content in our monitoring universe. So I can only recommend you go there and take a little look. Today, we are doing a deep dive into two topics that we highlighted in that report. We wanted to inform you about our views there, our monitoring activities, and also our analytical approaches there. The first one of the two deep dives is private finance. Now, of course, this is a very important topic these days in the financial market discussions. It's increasingly an increasingly important component of the global financial system, and it has grown in recent years very pronouncedly, both in private equity and in private credit. And in addition, it has actually attained a growing interest from a broader investor base. So this naturally brings us to the point that we not only analyze, but also include this in our monitoring universe. Clearly, our interest is both on the opportunities as well as on the risks, and the opportunities are apparent. Private finance can complement public markets and bank financing in very important ways. For example, by filling structural gaps in capital markets, they can support innovation, long-term investment, and economic growth. And of course, this is particularly interesting from our European perspective because we are now fully engaged in a discussion on how to actually promote European capital markets, the SRU discussion. And against that background, private finance has a particular importance for our work. At the same time, there are also risks and supervisory considerations that we have an eye on. And these include primarily the nature of private markets, which means that they are by definition less transparent and less liquid than public markets or regulated intermediaries. And with that, the capital might actually migrate towards less transparent segments of the financial system where potentially oversight is more limited and information asymmetries might actually be greater. In addition, there is opacity, valuation risks, and interconnectedness risks. All of them need to be better understood. And in addition, there is also an investor protection angle to that and one of market discipline. So we do take a very strong interest also from a risk perspective on private finance. And with that, as private financial market activities grow, we are stepping up our monitoring universe, both for the investor, but also for the financial stability risks. Now, the second deep dive that we're bringing to you today is around retail investor trends and risks. And we are looking at three striking developments in our TRV report this time around that we find of particular relevance to ESMA's activities. The first one is the rapid growth of retail investing via digital platforms. Digital-only brokers and neobanks have expanded quickly in the past 2-3 years, and in particular 2025 saw a sharp increase in new retail clients. And these new retail clients are often rather young, under 40 of age, and they tend to focus on equities and ETFs in their activities. So this deserves a particular look. Second, we look at the very strong concentration in AI-related equity investments. which also is a phenomenon in particular among younger investors. It is amplified by positive narratives on social media, and clearly on the pro side, it reflects the enthusiasm for innovation. But there is also a downside to this. These investments in AI-related equities, they are associated with risks linked to higher valuations, information quality, and herding behavior. And in particular, they provide an exposure to yes technology stocks, which are at the moment, due to their valuation, quite risky investments with the particular risk of disorderly market corrections. And the third risk we're looking at is leverage products such as turbo certificates, an area of the market where we see continued and persistent losses to retail investors. And this is reinforced by long-standing concerns about product complexity, the risk-return profiles, and the suitability in an increasingly digital distribution environment. From that, as we will see, we conclude that both the digitalization and the product innovation are positive in the sense that drive more retail investments, and they help include a number of investors. And at the same time, there is stronger risk taking, and the investment outcomes develop at very fast paces. So here too, we monitor and analyze the market developments on a continuous basis and inform the supervisors both here at ESMA RTU level, but also at the national level amongst our national competent authorities. We're very pleased to share with you details of this risk monitoring in these two important areas. And the details will be brought to you, first of all, by Christian Winkler, head of our Markets, Funds and Infrastructure Analysis Unit, who will present to you our take on private finance. After that, Alex Harris, Senior Analyst at our Consumer Sustainability and Innovation Analysis Unit, will take you through our retail investor analysis. And that will be followed by a discussion. We'll open up to you as the audience the possibility to ask questions and discuss with us. And the discussion there will be moderated by Anne Chaunet. She's a senior analyst at the Consumer Sustainability and Innovation Analysis Unit, and she actually led as a lead editor the Risk Monitor, the TRV production in the current edition. Thank you for joining us today. I'm very much looking forward to the discussion that we have with you. And with that, I'm handing it over to Christian. Christian, over to you.
Many thanks, Steffen, also for the kind introduction. And as Steffen said, I will talk you through private finance, and especially also the risk landscape and the links into asset management, because that is one of the aspects that from an ESMA remit concerns us the most. So what I'll do is I will first provide you with a little bit of a bigger picture on private markets, some of which Steffen has already mentioned. Then a bit of an overview of the risk landscape, how private finance and the risk landscape fits into the wider financial system. Then talk you through a little bit about recent market developments in the EU from our regulatory data, and finish off with a few considerations around materialized risks on the private credit side. So on private markets, so the question really is opportunities and risks. So is it a fuel for growth, or might be a cause for concern? So if you're looking at the fuel for growth thing, like Steffen has already mentioned it's part of a SAU solution to EU capital markets. So it's diversification of funding sources on top of bank lending and public markets. And by this, it can fuel innovation and long-term growth, and also could direct finance more directly to key sectors, like looking at tech sectors or defense sectors. And it's also a complement to public finance, as it can help grow businesses, especially in the pre-listing phase, and can also be used, private financing can also be used in synergy with public financing. But the causes for concern, from a risk perspective, are there, and it's probably also worth repeating them. It's a competition with safer public markets, where public firms can go private, as we have seen, for example, the buyout of Electronic Arts, in the US, last year. And private credit can also compete with banks and bond markets. And then the question is around do we have the same risk management standards? Especially as it can move capital away from highly regulated markets, from the banking side on the CRR, investment side on the MiFID II, fund side on the UCITS, also like on the CRA side, and the transparency requirements. And in our space in ESMA, we then have the Alternative Investment Fund Manager Directive as a main regulation for kind of private equity and private credit funds. And overall, and I will go back to that kind of in more detail in a minute, the risks around this are kind of the opacity of private markets, and that's kind of as opposed to public markets is kind of already in the word. There are potential quotation risks, and there might also be weaker standards than in public markets. Now, how much of concern or how much of an opportunity kind of there is also depends in a way like on the size of kind of the private markets. And maybe 2 points to mention there. One is, and you see that on the top, the chart on the top left, is that private capital markets have gained ground over the last couple of years. And here what we see is basically the percentage of kind of the total private equity side or private credit side compared to kind of the overall size of equity and bond markets. And we see that basically like they have grown significantly both on the private equity side and the private credit side, and both in all regions of the world. But compared to the overall size of public markets, it's still relatively small. In terms of absolute size of the markets, we see that's kind of chart on the bottom left side. We see kind of that private markets are much larger in the US than they are kind of in Europe or Asia or the rest of the world. That's true for private equity, but especially true on the private credit side, where kind of it's really the private credit, it's really the largest size of the market is in North America, in the US. But you also see that, especially on the private equity side, that the European markets have grown significantly, and I will come back to that in a minute. Now, overall risk landscape. And what I just want to bring out, like on with this slide, is that kind of it is quite complex how kind of private finance links into the broader kind of financial system, be it on the banking side, be it on the insurer side, be it on the investment fund side, be it also like on the overall kind of interconnectedness side with kind of the within the financial system. So if you look at system-wide drivers, so kind of on the top of this slide, we have kind of a lot of interconnections with the banking, asset management, insurance side of things. And we have seen that kind of private finance, though it's still much smaller than the public markets, we have seen kind of fast growth of private finance. And it's complementary to bank financing. And with that, like you also see kind of the banks are also kind of involved indirectly. So there's kind of, let's say, indirect lending by banks because they are also funding private equity and private credit firms. Now, and as with kind of many kind of areas in the financial sector, you can also see that you kind of might have potential procyclical effects and wrong way risks, because like if you see kind of that bank funding might rise as the private credit asset quality falls. And we also see, like in terms of potential like system-wide drivers, there's a high complexity of contracts for kind of in the private equity and private credit side. Now, still kind of also in the private finance side, the bank roles are central. They are kind of sponsoring capital of vehicles. There might be direct lending, as I already said, like they are counterparties in derivatives and securities financing, repo transactions, and they also have a large role in kind of advisory business on the IPO, M&A, leverage buyout side. On the investor risk, on the investor side, well, we have also seen that there are rising insurer and pension fund exposures. There are also investments in private finance also have kind of an element of search for yield and incentives for capital optimization. There might also be ownership relations between kind of different investment vehicles and kind of and sponsors of on the investor side, on the sponsor side. And there's also the product complexity, and private finance investments, be it on the private equity or private credit side, tend to be long-term and tend to be also illiquid investments with the risk that poses. On the regulation side, if we see private finance might also be seen as an arbitrage away from bank capital requirement, it's less regulated than public capital markets. And with that kind of follow also potential issues around low disclosure reporting and low transparency. Now, moving to the risk side on the fund side for private equity and credit risk funds, this might be more limited, but there's also an issue around transparency. So if you look at private equity, private credit funds, the liquidity risk of those funds is limited because the funds are largely closed-ended to really like a very large maturity, or they have a long notice period if they open-ended. You also see that kind of investor horizon are long-term. On the leverage side, in the funds itself, basically there's relatively low leverage in the funds, but there's high credit and leverage risks in the invested companies. And also, if there are any contractual relations, especially on private contracts on the private credit side, they are at arm's length, but they are also light on covenants. On the fund side, there might also be an issue around incentives. Unless the general partners of the funds have own stakes, there might be limited incentives to manage kind of risks. So there's kind of that might be different compared to the banking side. And we have opacity. So there's a low visibility of transaction conditions and also risks around it. And there's also a low periodicity of valuations. So that is the overall risk landscape. And I come back to more concrete examples later. Now, in terms of the links into asset management and the recent developments, which we also see on from our kind of data on from the ETF Investment Fund Manager Directive. So on the top left, you see kind of the growth of both private equity and private credit. And what you see is that kind of they have started off at roughly the same size, like kind of 8 years ago. And the growth on the private equity side has been much more sustained than on the private credit side. So we have seen kind of nearly quadrupling of funds of the fund size on the private equity side, and basically a doubling since 2020. The private credit funds size growth has been smaller, but still also pretty sustained. Now, looking at leverage, and as I already said, like it's generally low at the fund level, and especially like if we look at private equity funds, overall they are managing only like 16 billion substantially leveraged private equity fund only manage 16 billion of assets in total. And that is kind of small compared to the overall 700 billion something overall kind of market size in private equity in the EU. But what is important here that this could also underestimate the leverage, as kind of the leverage is more with the holdings of the private equity funds, and which might then be quite leveraged up once private equity firms are taking kind of companies over. Now, one element which is always can be tricky on the fund side is in terms of run risks, because what we have here on both on private equity and private credit are illiquid assets. So the question is how is kind of the exit of fund managers of fund investors managed by the fund managers. And here, like on the private equity side, like we have 95% of the private equity funds are closed-ended, so we don't have that risks. And most of the open-ended funds have notice periods of more than 3 months. So that risk in terms of kind of investor runs on these out of these funds is pretty limited. Now, on private credit, in more general terms, like we have leverage limits under AFND 2, but there might be a layering of credit risks across the structures, like funds and then the investments within the funds. And there's also interconnectedness with financial institutions, especially like on the insurer side, like in the US, we have seen that. We also still have kind of, and there's kind of new reporting requirements on the UCITS and AFND come through. We have also data gaps. And because we have kind of illiquid assets, we have inherent valuation risks, as we also have them with kind of other illiquid assets, like in the real estate space. Now, I want to finish off with a kind of few considerations around risk monitoring of in private credit, and especially like in credit risks there, because this has been like in the public pretty significantly, and also in the press over the last couple of months. And so why do we have the growing concerns in private credit? And one thing to say is these concerns are really, especially in the US market, where the market is still very much larger in absolute terms than it has been in the EU, and has also been expanding for many years. So what we have seen overall is we have seen already an upward trend in default rates in private credit and leveraged loans. And especially like when you look at selective defaults, considers that basically the kind of payment in kind where kind of interest is added to the loan. That has been really picking up over the last couple of months. There's also a generic lack of transparency, especially regarding loan quality, and that can lead to unexpected losses and also contagion risks in terms of the investors, and also especially given the high levels of interconnectedness with other markets. So they can go into the banking side, can also go into the investor side. Now, a few pretty specific, more specific examples on the potential risks of contagion from US private credit markets. So the most prominent example was, in fact, like last September, where we had kind of sudden, unexpected large losses in two US firms, in First Brands and Tricolor. And both kind of, this was really tied to kind of off-balance sheet exposures and triggering kind of rapid credit rating downgrades, and kind of as kind of there was kind of potential risk of bankruptcy. And in both cases, there are investigations for fraud. Now, what you've seen there, that's basically three things around Tricolor and First Brands and Tricolor, which are relevant. First, kind of the events have caused significant losses for exposed banks, and examples for that, all of this which is public, are Jefferies, JP Morgan, and the UBS. And these kind of surprises is also kind of the UBS example also shows that kind of the risk can also materialize and affect European firms. And again, like this is linked to lack of transparency on loan quality, private ratings, and exposures. And overall, kind of First Brands and Tricolors have brought private credit under a bit more scrutiny, and thinking about kind of increasing risks and also potential parallels with what we had seen like in the great financial crisis in 2008 on securities subprime mortgages. Now, over the last couple of weeks since we have published the TRV, we have also seen kind of many kind of developments around private credit funds in the US, especially around kind of redemptions and funds putting in kind of redemption gates. And that also was particularly related to kind of the more semi-liquid business development company funds, which are kind of a wrapper how you can invest into private credit. And there, like in the BDC funds, was mostly around software exposures prospect, and that kind of those prospects have been hit by kind of AI developments. And you have really seen, as I already said, like investor redemption surges well above kind of the limits that have been imposed by these funds. And we have seen this in the last couple of months. And with that, I would hand over to Alex for kind of the consumer side of things, and happy to take any questions after Alex has finished with his presentation.
Thank you very much, Christian, and good morning, everybody. So this part of the presentation will cover consumers and developments that we're seeing among retail investors in the EU and have been seeing in recent months. A key trend, and I think a big kind of story from 2025, has been increasing retail investor participation, and in particular, large growth in new clients using digital platforms. So we've seen digital-only platforms, including several prominent neo-brokers, coming into the market in recent years, and increasingly offering a range of products. Many tend to be execution only, but there are other services also offered. And we see increasingly the market is kind of relatively concentrated among a few providers, but to check our analysis, we also looked at a very large number of kind of smaller providers also providing digital-only services, and found that the trends were kind of evident using this larger sample too. We see also the profile of investors. So this is from our EU-wide data. We're able to see what year investors were born, and we have a profile which I think would be perhaps what we might have expected to see. Over 2/3 of investors aged under 40 among new investors in 2025, and a quarter of those were actually aged under 25. So young adults first becoming involved in capital markets. And we've seen also that if we go to the next slide, that we have in particular focus on exchange traded funds and equities by these new investors. That's, I think, something that's somewhat reassuring. So key benefit of digitalization can be promoting participation, helping investors gain access to capital markets and save for the long term, and invest and realize a return that can help them achieve their long-term goals. And ETFs, and if additionally equities, if in a part of a diversified portfolio, can be one way for them to achieve that. We've seen smaller numbers of other products, and with bonds, which of course also can be a good way for investors to do long-term investing, as also to help them manage their risk profile. We see some peaks in the data in the blue line on the top charts. Those are associated with retail issuances, or so issuances by member state sovereigns, particularly targeted at retail investors. So in Italy, especially, bond investing is relatively common among retail investors. One thing we see as quite a stark difference, though, between bonds and other so ETFs and shares, so other key asset classes for retail investors, is the mode of distributions. So for bonds, the overwhelming volume is distributed through traditional brokers, whereas for shares and ETFs, there's a significant and also increasing share of volumes going through digital platforms and prominently neo-brokers. So those are the bars, the blue parts of the bars on the bottom chart there are the digital platform trade volumes by asset class. We actually see an even more stark difference if we look at just numbers of transactions. Alternatively, as the size of transactions via digital platforms tends to be smaller, that's also associated with the prevalence of fractional share trading that's offered by many neo-brokers and neobanks. Moving on to the next slide, a related phenomenon in the increasingly online interconnected environment that retail investors find themselves in. We've seen these younger investors, often disproportionately represented in digital platforms, and new investors in the market as well, are seeking AI exposure to a greater extent than older age groups. So this is the top chart on the left, and we saw that over the year 2025, over a third of equity invested by those in the 18 to 39 age group was in companies that were linked to the AI sector. So that's nearly 3 times the proportion in over 70s. Now that does have some advantages, and we can see benefits from younger investors perhaps investing in growth stocks, and according to economic theory, have capacity to invest, especially as part of a diversified portfolio, in in a portfolio with a higher risk level given their stage of the life cycle. At the same time, we do see some significant concentration, and valuations are especially high among AI stocks. So valuations are possibly predicated on a range of different outcomes. So in some scenarios, AI could have a transformative effect across the economy, which would push up equity prices further, but in other scenarios, it's possible that there could be a significant downward correction. And while it's very positive overall that we're seeing increased participation, also in line with the aims of the Saving and Investment Union, both helping households participate in capital markets for their own benefit, and also tapping the capital for European companies. We are seeing, potentially the risk that there could be a disorderly correction, which would then, in particular, be detrimental to EU investors. And also, if it's newer, younger investors who are affected, there could be a knock-on effect to future participation. So we would like also to see, of course, sustained increased participation in capital markets among households. One related phenomenon that's, if we look at the bottom chart, one related phenomenon is in the realm of social media, and the bottom chart plots, firstly, the kind of background grey bars are just numbers of AI-related messages. So in particularly, there's, to explain a little more, these are messages in our data set from a commercial provider on social media messages from several large social media platforms. And these are messages that reference stocks that are in companies that relate to AI. So we've seen no clear trend in the overall volume of these messages. But one thing that's quite notable, if we look at the green line, is that we see a high and increasing share of messages which have positive sentiment. Now, it is a minority of the messages, so the interpretation here is important, but we can categorize them as positive, negative, or neutral. And we can see here in the text describing the chart that there is a relatively large spread, so delta of 10 points where positive messages outnumber negative messages. So an interpretation there is that we are seeing positive sentiment that could potentially be straying into hype and leading to unrealistic expectations among investors. It's worth noting as well that in some of these new digital platforms that we were mentioning just now, social media feeds may be embedded. There may be also some kind of in-platform social media elements in the platform design. So there are kind of different influences and information sources on investors. So having looked, I think it's some kind of key short to medium term trends, and looking at how the consumer market has been developing over recent months in the last year. We also took a look at a more structural issue, which is the trading of speculative leverage products by retail investors. Now, this is an area which ESMA and other authorities and NCAs have looked at in detail in the past. So we took a look in particular at turbo certificates. Those are financially strongly similar to contracts for difference, CFDs. But CFDs are over-the-counter contracts, whereas here we're looking at securitized products. So there are some differences. For instance, it's by design not possible to lose more money than you put into a securitized product in this context, whereas with CFDs, prior to action taken by ESMA and then by national authorities, it was possible to lose more money than you put in. So if the effective margin went to zero and the price continued to fall, retail investors in some instances ended up owing large amounts of money to providers. So that was addressed through through measures at the time taken under MiFID product intervention powers, but some other key measures were also included, and this is for CFDs, so these over-the-counter products that are similar in structure to turbo certificates, and some key measures included risk warnings and also leverage limits. So we have a good understanding of how leverage affects outcomes for investors. It can be detrimental for different reasons. One is that losses can be larger. So at the same time, of course, returns and gains can also be higher because losses and gains are both magnified by the effect of leverage. So that's an amplification of the underlying market risk. There's also a risk that if leverage is high, investors are more likely, through the kind of magnification of the fluctuations in the value of the product, more likely to be knocked out. So if the value of the kind of equity stake that an investor has in a turbo certificate goes to zero, then the product is liquidated. And in some cases, there can be a small residual payment to the investor, but typically there's zero value left in the product for the investor. And this in itself, crystallizing losses in this way can also be associated with investors then re-entering, buying more products to kind of re-enter and re-participate in the market. And that comes with costs. So every time an investor buys a leveraged product, they will be incurring costs, and those costs are relative to the total notional amount. So in effect, the costs are also magnified. So with this kind of strong framework for understanding what's going on with these leverage products, we took a look at the data, and we have EU-level data, which shows hundreds of thousands of retail clients investing in turbos each month. This often takes place through digital platforms. And we see that there's a structural negative expected return or loss-making outcome from these products. That can be understood also quite intuitively. So we have kind of short-term exposure, which can be long or short to market movements. There's little directional tendency and predictability in the price movements. So absent costs, around half the time you would expect to have a positive return, half the time negative. If you include costs, which of course are an inherent part of the product, then we typically see a significant majority of investors losing money. And indeed, that's very similar in the pattern we also see for CFDs. And there I mentioned that risk warnings are required for the offer of CFDs to retail investors. And there we can also see reported by the providers themselves that a large majority of investor accounts are loss-making. So again, the parallels are very strong. And for those reasons, in the Netherlands in particular, the Dutch NCA, the AFM, introduced restrictions on turbos that mirrored the CFD measures in 2021. And we also seen more recently some measures introduced by BaFin in the German market following a detailed study that was published last summer by BaFin. And we also find that in broad terms, the results we found from our analysis chime with the BaFin results too. There are some differences between the details of the measures that the two authorities introduced at national level. You may wish to refer to the ESMA opinion on the BaFin measures, or indeed the market study that I mentioned in the slide too. But moving on to the results on the second part of this section, we do then see confirmed as expected from our conceptual understanding consistent and persistent average losses at investor level. So we have the green dots in the chart being the monthly average return that we've estimated from the data. The total turnover size of the market by purchase value is the blue bars in the background. And the scale for the green dots, so the returns, is with reference to the right hand axis. So almost all of these these returns with the green dots are below the zero line. There are a couple of exceptions on the left. So we see 2 months there was some positive returns, and so the variability comes from just the natural variation and randomness in short-term market movements. It's worth reiterating that these tend to be very short-term positions that are open. So a large majority of positions would be intra-week or even with intraday positions. So investors would be taking positions on or speculating on movements potentially over the space of a few hours. It's worth noting as well that we're focusing here on risks. There can be other value from these products too. So even if they relate to persistent financial losses, they can, at least in theory, be used for other purposes such as hedging, though it seems unlikely that that's a key use for them. It's worth also noting that there can be some sort of psychological payoff from participating in short-term speculative trading like this. But we overall, on balance, see the very large risks here for retail investors in line with the restrictions that are in place in the key markets of the Netherlands and Germany. One final remark is that we estimated from the data using certain assumptions, but the results are robust if we vary the assumed parameters by, for instance, doubling the assumed residual payments. We end up qualitatively with the same results. So the conclusions we have are robust there, and we also look to see if there was a major difference if, for instance, we just looked at long positions versus short positions. There was no very clear systematic difference there. We also looked at different types of underlying. We tended to see greater losses with single equity underlying as opposed to indices, reflecting the greater variability of price movements in a less diversified underlying. And it's, I think, perhaps also yes, worth noting that this is an area that we can continue monitoring in future, but we would expect these structural trends to remain apparent. So with that, we've taken, I think, a look at different areas of the consumer market. We've seen some positive developments, but as this is a risk monitor, we've been focusing in particular on some key risks affecting retail investors. Thank you.
Thank you very much, Christian and Alex, for this insightful overview of private markets and also trends in the retail investor behavior. I think once again, these developments show how quickly markets are evolving and the need for us supervisors, policymakers, to keep abreast of those developments, to assess and address the risks they raise, but also make sure that we also understand the potential benefits for investors, the market, and again, that we have a relevant response in line with our mandate, which is, as you know, to protect investor, market integrity, and financial stability. I'm just looking at the Q&A tool. I don't see questions at this point, but for those of you that may be less familiar with the way these ESMA webinar works, I just want to highlight again that you have the opportunity to raise questions in the Q&A tool at the top of your screen. We won't have an open discussion, so we won't let participants speak for efficiency purposes. But again, you're very welcome to raise questions that you may have on the two presentations or more broadly on our risk report in the Q&A tool.
So I think we can maybe leave a couple of minutes more in case some participants didn't have the time yet to ask their questions. And in the meantime, I would just like to remind you of this ongoing monitoring work that we do. The topical risk article that we regularly publish on a range of different topics. For instance, recently on artificial intelligence, we will have one coming shortly on quantum computing. We had some articles on the cost of retail products for investors. And as you know, the presentation that we made today is grounded on our semi-annual Trends, Risk and Vulnerability report. This one, the last one, was published in March, and we'll have another one after the summer. So just stay tuned. There's lots of interesting publications on various topics coming from our end. And with that, I'm just checking again. I'm not sure we have any question at this point. So I don't know, maybe Christian or Alex, let me know if there's a final word from your end. But otherwise, I think we can close the webinar from now. And Christian, I see you may want to say a word. So.
No, I think you summarized it very well, like, and also like summarized very well, like the publication landscape we have, and also like if there are any questions from kind of participants to kind of to the meeting, very happy like for you like to send them kind of to us, also like to our communications colleagues, and we'll be happy to answer them.
Thank you very much, Christian, for the clarification. And with that, I'd like to thank the presenters and the participants as well. If not, we'll close the webinar now. And thanks again to everyone, and have a very good rest of the day. Thank you.
Thank you.
Thank you very much. Bye-bye.
Thank you. Bye.